With all that being mentioned in law number 1, let's segue your way into law number 2. Never let emotions affect your trade. It's imperative that you understand this law. Never let emotions affect your trade. Never let a feeling or a hunch or a random idea to influence your decisions. Decisions should always be planned, and we're going to get into that. But nevertheless, never let emotions affect your trade. Never let emotions affect your financial decisions, period. Having no emotions provide what we call healthy leverage. You have to understand that emotions cloud judgment, clouds reasoning, clouds your ability to actually analyze information for what it is. Emotions are known as the market liars. They're not the market indicators, they're the market liars. And you don't want to be lied to when you're in the market. You want to have the information for what it is and nothing else. Once emotions are involved, your trades are automatically flawed. Your investments are automatically flawed because you weren't able to think with clarity and with depth. You weren't able to analyze the data for what it is. You weren't able to make the accurate financial investment. You weren't able to do your best. You know, like it's like FOMO, chasing. You're running after something. You see a stock spike and you want to get in, and the fear of you missing out, you're chasing, and in the midst of you chasing, you didn't analyze the data, and then what happened? In a matter of minutes, in a matter of seconds, the stock tanks. You have to understand that when you see massive movement in the market, a lot of times, 9 out of 10, 8 out of 10 times, most of the gains are gone. So there's no point chasing after gains. There's no point making a move without a plan. There's no point being emotional or emotionally attached. In conclusion of this law, every play should be made with rational composure and total understanding with a plan in hand. Law number 3, never trade without a plan. The blueprint. There has to be a set way of doing things. There has to be structure. There has to be foundation. You should never trade without a plan. You should never trade if you don't know where you're going to enter, where you're going to exit. You should never trade if you don't know what are the deprecating and reciprocating factors. You should never trade if you don't have the information. A builder has a blueprint to build a house, and it's no different when you're trading. You have to have a plan. You have to have a set plan so you know what you're doing, so you know when to do what you need to do. What's your pre-market plan? What's your scaling plan? What's your entry and exit plan? If this happened, what do I do next? An artist has a mental plan of what they want to draw. You can't go in blindsided. You have to know what you're doing. You have to know what you're getting into. You have to know how much you want to invest. You have to know how do you protect your capital? You know, what's your risk management? Do you have a stop loss on this? You have to have a plan set up. You have to have a plan set up. You have to have a plan to protect your gains, protect your capital. You have to have a plan to protect you from you. You have to have a plan to protect you from being emotional and doing something irrational. You have to have a plan to protect you from making a mistake. You have to have a plan, something that you can follow, something you can structure, something that you can actually utilize to make sure that you're an efficient, effective, winning trader, winning investor. You have to have a plan at all times. It's imperative, it's absolutely imperative that you execute trades only when you have a plan. Law 4, practice. You would think us as investors, traders, would understand this law and would before we do anything, would practice, would know our way around the woods. You have to get burned a few times. You have to understand how everything works. Because the big bad wolf will come and huff and puff and take your money away. And that's the stock market. That's the Forex market. That's any form of investing if you do not know what you're doing. Because if you don't know what you're doing, if you haven't practiced, you're gonna lose. I'm gonna define the term practice in an effort to drive home a point I'm trying to make. The term practice is defined as to perform an activity or exercise a skill repeatedly or regularly in order to improve or maintain one's proficiency. That word, proficiency, in order to maintain or improve one's proficiency. That's what we're looking for here, guys, to improve and maintain your proficiency, your win ratio, to get you guys in the win column. And if you have no experience, which you only get through practicing, you will never become the profitable elite trader you want to be. Practice teaches you patience and understanding, something that can't be taught by me or someone else. Law 5, research. We live in an information era, and information is imperative to what we do here. Information is the oil that greases the machine. It's the oil that keeps the motor lubricated. Information is everything. In order for you to make efficient and profitable investments, you have to research. Let us define the term research. Research is a systematic investigation into and study of material and sources in order to establish facts and reach new conclusions. There you have it, guys. In order to establish fact and to reach new conclusions, you have to know all the moving factors. Is there a merger coming soon? Where's the stock in its life cycle? What's a P ratio? Is it a negative or a positive P ratio? Is there any particular trends and patterns that you observe? Is the stock a media darling? How does it react to media coverage? When is earnings coming out? There's so much factors and information and aspect that you have to research, that you have to know what's going on, that you have to figure it out through information. You need to research in order to make accurate and profitable investments. Law 6, always diversify one's portfolio. Diversity is key in the market. There's a saying and it goes, you can't put all your eggs in one basket. And that saying applies here. You can't put all your capital into one investment. You can't put all your capital into one trade. If you have $1,000, it's better to spread it a bit. Spread to the point where you're able to make a substantial return on your investment, but not enough to, if you were to lose out on that investment, you lose a bulk of your capital. I mean, you have to think about your investment, you have to allocate your capital accordingly, and you have to diversify your portfolio. Diversification works because assets, companies, stocks, the market, it reacts differently to the same economical events. Things react differently, and that's why diversification is so imperative. It's so important. It's so crucial that you diversify one's portfolio. It's absolutely crucial. Enough can't be said about diversification. I know it protects you from making mental mistakes, so it protects you from blowing your account on one investment and one trade. You have to diversify. If you want to play the long game and win, it's imperative that you diversify your portfolio. Enough can't be said about diversification. Until I see you again, asset security.